All right, we'll go ahead and get started. We'll let people can join us after we get started. I want to thank everybody for coming this afternoon to the CARES Act overview, kind of a second version. And I'm Harold Moan. I'm the Regional Managing Director for UHY here in Columbia, Maryland. And I have on the line Jack Reagan, who is also a Managing Director with UHY. And,
hey guys, thanks for coming.
Yep. And we're going to, we have some questions that were sent in, so we'll get to those as we go through. And if you want to type your questions in, there's a section in the GoToWebinar bar over there to add those, and we'll try to get to all of them. If we can't get to them, we will try to follow up with everybody and let them know what the answers are. We want to make sure that we have plenty of time to help folks with the questions that they have.
Yep.
So with that, we'll go ahead and get started. As many of you, I'm sure, have heard, yesterday, and I think it was last night or this morning, when the president signed the bill, that the legislation to reappropriate money for the Paycheck Protection Program loans. There's $310 billion for that. There's $60 billion for additional monies for the Economic Injury Disaster Loan Program, $75 billion for hospitals, and $25 billion for COVID-19 testing.
Yep, and it looks like what's going to happen is there'll be a separate bill for some of the state and local government subsidies that are going to come out of this as well. So that one seems like it's going to be more of a knockdown, drag-out battle to get that funding through, but this one at least is going to open up the funding stream for at least hopefully more than a few days.
Hopefully. So what we'll do is I'm going to take us through a little bit of information related to the Paycheck Protection Program. I know that a lot of my clients who have now gotten their loans funded are a little more focused on the forgiveness aspect of it now. Spending a lot of time on the phone talking them through that. But the one thing to keep in mind is on the forgiveness aspect, we don't really have regulations yet, and we'll get into talking about that a little bit later in this. So as I'm sure many people know now, the loan program is available to those businesses, not-for-profits, veterans group, tribal businesses with less than 500 employees. It's also available to sole proprietors, independent contractors, self-employed workers. So it's pretty much anybody who puts their business on a Schedule C, even partnerships and those types of things. And then there's the exemption for hotel and food services. So if they have more than 500 employees under the NAICS code beginning with 72, that they would qualify for these loans. And I think you've seen a lot of news about some of these businesses that were restaurant franchises that were rather large and probably publicly traded that got money that now they're being pressured to give it back. So, and then the other aspect of it too is not many people know that there are other ways to qualify. So the SBA has some other, that even if you have more than 500 employees, if you meet these other standards, you will qualify for a loan. All right, so the way you calculate your maximum loan amount, it's basically your average monthly wages for 2019 times 2.5. And the maximum loan amount is 10 million. So there's a couple issues you have to take into consideration when you do this. Your gross wages, annual gross rate wages, is limited to 100,000. So if you have employees that make more than 100,000, you have to back out that piece of it that's over 100 in order to calculate your average payroll amount. Then you can add your employer health insurance premiums, unemployment tax, and then the employer portion of 401k plan contributions and pensions. The other thing that you have to exclude from that calculation are any employees that are not US residents. Those have to also be excluded.
Yep, and to me, Harold, the mechanics on this one, you know, they're guiding it with the average monthly wage. The legislation, really the goal was to try and get this out so that folks got an 8-week buffer for payroll costs, right? So that, you know, the underlying, but they goosed it up another 0.5%, or that's why it's 2.5, because they knew there were certain non-payroll items that we're going to talk about here in a second that needed to be incorporated. But the whole theory behind this, I think the mechanics of the calculation was they wanted to get roughly 2 months salary out there in these paycheck protection programs, hoping that that would be a long enough time until the economy got started again. And then they wanted a kicker in there for some of the non-payroll costs, and that's why that extra 0.5 is in the calculation.
Yeah. So the payroll costs are measured on the cash basis, which is basically what your payroll returns are done every quarter and the W-2s for the year. And so there's some alternative measurements. So if you're a seasonal employer, you can use the period from February 15th, 2019 to June 30th, and then come up with your average that way. If your business wasn't in business at February 15th, 2019, you can use your payroll of January of 2020 through February 2020 in order to come up with your monthly average.
Yep.
So the general terms of these loans is that there's a portion of, what's that?
Pretty sweet deal.
Pretty sweet deal. A portion of these loans can be forgiven as long as you use it the way they want you to use it. Interest rate is not to exceed 1%. I'm pretty sure all of my clients, their rate has been 1%. Haven't seen any that are less than that. Repayment term is up to 2 years. Deferment of payments for 6 months. There's no prepayment penalties. There's no collateral required. There's no personal guarantee required. And then you get approved for this loan directly through your bank or financial institution. It's not like the disaster loans come straight from the SBA. These come through the banking system. And then if you have any economic injury disaster loans, they have to be refinanced into the PPP when you get that. So these are the certifications that every borrower has to make. And I think that, I don't know if you listened to the president's press conference, I forget if it was yesterday or the day before, where they called out all the publicly traded companies that took the money. They were going after them under this first certification, that the uncertainty of the current economic conditions makes it necessary for the loan request to support the ongoing operations of the eligible recipient. And I know just the other day they came out with more information in a question and answer segment, a frequently asked questions part that specifically addresses that issue.
Yeah, and that clause basically said, you know what, we're going to give you guys a little bit of a grace period here. So if you give back, if you're a publicly traded company with access to public markets, you know, for stock, you've got real solid banking relationships where you can get other access to funds. We're going to take it that you did this on good faith if you give the money back by May 7th. So there are going to be a lot of businesses that are going to go through and figure out whether or not they meet those criteria that were in the regulations. And May 7th is going to be an interesting day, or a period between now and May 7th is going to be interesting to see how many companies give that money back. But I thought it was really interesting that they said, we'll presume you acted in good faith as long as you give the money back by May 7th. If you wait until May 8th, you might be hosed. I don't know.
Right. And then the other one is acknowledge that the funds will be used to retain workers and maintain payroll, make mortgage payments, lease payments, utility payments. I think that certification will kind of come up a little later when we talk about forgiveness and some issues I've run into with my clients as we've kind of forecasted this out. And then that you're going to provide the lender documentation that verifies all your numbers for full-time equivalents, payroll dollars, interest, payroll cost, utilities, all that stuff for the 8 weeks after getting the loan. And then the forgiveness is going to be provided for the sum of those allowed costs over that 8-week period, starting after you get the money. That is for payroll, mortgage interest payments, rent payments, utilities. And so, but you're limited that only at least 75% of it has to be for payroll. And the way they came up with that is basically they're giving you 2.5 months worth of payroll, which is about 10 weeks. And so at least roughly 8 weeks of that should be used for payroll. And that's kind of roughly how they came up with those percentages.
Yep.
So these are the allowed uses: payroll cost, payment on interest of any mortgage obligation, rent, utilities, interest on other debt obligations that were incurred. And I know we've got a question here that may fit in there. So the question is, can you use the PPP for any business purpose and just not be forgiven and pay it back over 2 years at 1%? I believe that based on this right here, the answer to that is probably no. Right? Because if you take it out and you use it on something that's not listed here, that's not an allowed use. And if you go back to the certification you made that you were going to use the funds for this, I think that those don't align, basically.
Now, I have seen, Harold, some discussion again that there are several congressmen that are looking to introduce legislation, whatever the next round is, to relax that 75% rule. I don't know whether that's going to make it through, but there does seem to be some groundswell of support, at least nominally, for relaxing that 75%. The other thing I want to emphasize here is the word interest. So, a lot of us, obviously, when we write our checks for the mortgages and the debt, it's principal and interest. Make sure that you're segregating out the principal piece from this, that you're only getting reimbursed on the interest portion of those debt payments.
Yep. Nice. So then we come to the ever important loan forgiveness calculation. And one of the things just always kind of keep in mind is that we don't have regulations for this. And so we have limited information, and we expect to get regulations soon, which hopefully will clarify some of the issues out there that we don't know the answers to. But we're going to go through kind of what we know, and I'm sure that you're going to have questions that we probably may not be able to answer, because I've been not able to answer some questions that I've had from my clients. So, so basically your loan forgiveness calculation is going to be the sum of the payments that you made in the 8 weeks after you got your money. All right, so it's going to be your payroll costs. It's going to be your rent. Remember, when the payroll cost for your wages, it's going to be limited to $100,000 in wages for the employee, and that's on an annual basis. So you have to break that down to whatever your payroll period is. The rent, utilities, and then again, interest payments. And there is going to be, after you do that calculation, then you have to look at what it could possibly be reduced. So you calculate that amount, and it could possibly be reduced if you have less employees at the end based on the measurement dates. And those measurement dates are
February 15th.
Yep, if you've got, you're going to take your full-time equivalents during the 8 weeks, and you're going to kind of compare that to the full-time equivalents, the average full-time equivalents per month that you had from February 15th of 19 through June 30th of 19, or you're going to look at 1/1/20 through 2/29/20. So, there's going to be a possibility that even if you calculate what your forgiveness is based on what happens with your employees, that could be reduced. And I know Some of the questions that I've got is, what do they mean by full-time equivalents? Do I have to include part-timers as part of that calculation? That's something we're waiting for clarification on. And so what we've done is I've told my clients to basically just use the definition that's consistent for the two measurement dates and document why you used what you used.
Yep, and Harold, I keep coming back to, when we have these sort of questions, what was the congressional intent on this? And you said, so if you get to the underlying nature of this, we took average payroll, monthly payroll from last year, said, all right, we want to make sure you're being made whole for that payroll that you're paying this year. But if you reduce the number of full-time equivalents as a result of this relative to last year, or you reduce the salaries and wages of folks relative to last year within certain covered periods, we're going to knock down the amount that we allow you to that we allow to be forgiven. And again, the thought is the Congress is trying to get cash in the hands of the workers so that they are made whole relative to where they were before this happened. So if you take actions, whether it's reductions in force or reductions in salary, they're saying that they're going to proportionally back down some of the amounts to be forgiven.
So let's just, Jack, take a minute and go through some of the questions we have here. And so the first question that I have here is floor plan interest allowable for the forgiveness part of this deal? I believe that any interest expense that you had is going to be an allowed use, right?
Yes.
So I believe that the answer to that is yes.
Yep,
as long as it was incurred before February 15th of 2020.
Exactly. And I cribbed this language right out of the legislation. So it says explicitly interest on any other debt obligations. It specifically calls out mortgage, but it says, yeah, if you've got other stuff, so floor plan interest would definitely qualify as other debt obligation.
Yeah. Yeah, and so kind of going back to the other question that we had too, where it was asked about using the proceeds for other purposes. One of the things, I have a client that doesn't really have other expenses. Most of their expenses are payroll related, and they've calculated that when they get to the end of their 8 weeks, they're going to have excess money left over. And I don't have a definitive answer whether they're going to be required to pay that money back, or if they're going to then be allowed to keep using that for payroll, that it just won't be forgiven. We just don't know the answer to that as we sit here today.
Yep.
Let's see, does the healthcare forgiveness include only medical insurance or also life and disability portion on that same bill?
I think it's the entire benefits package. I mean,
Yes.
they're looking at this as trying to replenish the total compensation package of your employees. So if you've got life and dental and all those other sort of things that are out there, I think that's part of the total compensation package that they're seeking to reimburse.
Yeah. All right, so then another question we have is if you settle your loan on Wednesday, 4/15, and you payroll week runs 4/15 to 4/21, paid on Friday, 4/24, do you start counting your week with the payroll paid 4/17 or the payroll paid 4/24? We don't know the answer to that for certain, but I think that in most so far in most cases when they look at stuff, they're looking at it almost on the cash basis, right? So I actually had a client that funded on a Wednesday and their payroll was on Friday, but that Friday's payroll was for the period before they got funded on. And we took the position that it's kind of cash basis. So that payroll on Friday gets paid out of the PPP proceeds. And I think we just have to be consistent on the other end when we get to the end until they give us more regulation. When counting full-time employees, does a part-time person count as a half regardless of the amount of hours under 30? We don't know the answer to that yet. So we will hopefully know soon. Can you use PPP for pay periods prior to receiving the loan? Because we have been paying employees since closings from 3/16. No, you can only pay for them, the payrolls that you pay during that 8 weeks after you get funded.
Yep.
You can't use it for prior periods. Let's see, the next one. We determined that this is great. We got lots of questions here. I like it. So we determined that the monthly rate from payroll minus the amount for employees over 100,000. When we get the loan, can we still pay those employees a regular salary if it's over 100, as long as the 75% rule? You can pay them if they make over 100, but it's capped at 100 for what you use the PPP funds for. So you can pay them out of other cash sources, but not that excess over 100 out of the PPP. I think that answers the question. Yep. If you still had the same income coming in, would you still qualify for the loan forgiveness? Yes, there is no, I don't think there's a specific, it's almost like if you have the same income coming in, do you get to qualify for the PPP? So it kind of goes back to the certifications.
Yeah, it's certification number 1 that I just scrolled back to. You know, that's what they're going to push on. And
when all we have is this one question answer on it, so we still, hopefully they're going to give us more guidance on what exactly that means.
Yep.
Speaking of conditional intent, I know you mentioned sole proprietors. At some point, can you make some suggestions on how sole proprietors can increase their chances to receive a loan? They are in a long line. That's correct. And I wish I knew how to increase the chances of receiving a loan. I've got a number of clients that have got applications in at the bank, and the bank, even though they have their applications, has sent them emails recently telling them they don't know if they're going to be able to fulfill it, because rumor has it that this new money is going to run out in a matter of days. So the answer is just talk to your bank and try to keep in contact with them. If you don't hear from them, call them so that you can try to keep it moving through the process. When the applicant is an LLC, does it submit its 1065 as documentation? That kind of depends on the circumstances, right? So if you're a 1065 in a partnership, I've got partnership clients that pay out wages to employees, so they're still going to give that same wage information as any other company would. However, if the owners of the LLC that does a 1065 has kind of like guaranteed payments, which is like their self-employment piece, they're going to have to submit additional documentation, because that piece of it's almost like independent contractor type of stuff. So you got to include that a little separately when you give it to them. Hope that answers that. Our notice for approval from the SBA is dated April 17th, but we did not actually get the funds in our bank account until April 24th. What date should we use for our funding date to start our 8 weeks? So it would be today, April 24th, because once the SBA approves the loan, the bank has, I think it's 10 days to fund the loan. So in this case, they funded it in 7 days, so they're within that. And your date starts the day you get the money is the start of your 8 weeks. What if work is not there in the next 2 months? How would you pay your workers to meet the 75% payroll criteria?
You're paying them to stay at home.
Yeah.
The goal is to get them off of unemployment insurance and keep them employed. If there's not work to be there, theoretically, you're supposed to be paying them to stay at home. And we've all heard stories. I think about, anecdotally, especially with a lot of states have put like a $600 kicker in on unemployment comp, that unemployment regular plus the kicker is greater than some of these wages. So when businesses have been getting these paycheck protection loans, they have been going back to the employees saying, we'd like you to come back to work. And the employees are like, I don't want to come back to work. I'm making more money being on unemployment. But again, getting back to this, the whole theory is to keep them employed, keep them with a regular paycheck, even if there's not regular work to be done. The intent of the program is to pay them.
Yeah, I've got a client that has that issue, and I think that he's going to pay his people full time, even though they may only have 20 or 30 hours of work during a week, just so he can meet the intent of the law as far as what he's doing to use the money for. All right, here's one other one. I think this is the last one, then we can get back to the presentation. If last year we averaged 20 employees, but we laid people off weeks ago, and we try to rehire them and they don't come back, just kind of what Jack was just talking about, do we have to hire new employees to meet the 20% employee average? And I believe the answer to that is yes.
But I'm going to suspect, because there are too many stories out there about employers trying to offer employees jobs back and the employees refusing to take them because they're making more on unemployment. I got to believe somewhere along the line, there's going to be something that says if the employers can demonstrate that they tried to offer this employee their job back and they chose not to come back, I got to believe there's going to be something in there. There's just a gut feeling, nothing whispered, nothing heard, but there's going to be something to deal with that at some point.
Yeah. I think unfortunately though, until we have that guidance and regulations that they issue, the answer to that question is yes.
Yep, I agree. So, I agree. That's the prudent course.
All right, back to the presentation. Where were we, Jack?
We are going into, actually, this is a good segue into the rehire exemption.
It is. So if you go through and, when we talked about measuring your employees on the two specific measuring dates to determine if your forgiveness is reduced, there is this exemption that they will not reduce it. They will forgive your reductions if you meet these two requirements. Your rehire employees that were laid off or fired in the period from February 15th to April 26th, and you restore up to 75% of employee salaries that were reduced during that period from February 15th to April 26th. And both those requirements need to be met by June 30. So, as the question was before, it's hard if people you can't force them to come back. I don't know what the answer is. And I think that's probably part of the reason that Jack feels that at some point in time, they kind of have to address that. All right, we got a couple more questions and we'll take this before we get into the documentation list. Yep. So it says, but isn't that S Corps can pay their owners to abuse the law to meet the employee count? Not sure of the question, but my S Corp clients do pay the owners through W-2, and they will be treated like any other employee for this purpose, and they're going to be capped at the $100,000, and I think that's part of the calculation. I don't think there's any kind of limitation that you can't include the owners,
right?
Because they're employees of those corporations. If our payroll is based on a year-end bonus, can we pay a mid-year bonus to meet the payroll requirement? So I assume what they're saying is at the end of a calendar year, they pay out a bonus to their people. And so if they're paying out these 8 weeks, could they pay the bonus out in June for half of what it average was? I don't know the answer to that.
Yeah, I think there's going to have to be, there will be some guidance, I suspect, coming out around variable comp like that. And there'll probably be some proration. I've seen some discussion out there in the forums about how people are trying to calculate the impact of that, because remember, you've still got that $100,000 top end limit on compensation. So there's going to have to be some sort of annualization calculation that gets into this if you're paying some variable comp.
Yeah, yeah, I think until you get some, I think I could make an argument that if you can estimate that and you take a piece of it and you have your rationale documented as to why you did that, I don't see anything keeping you from doing it now.
Right.
Especially if there's no guidance of it before the time you have to turn in your application for forgiveness, then I think it'd be reasonable. I would think that at some point in time they will address that. And then the last question here is, how do we handle paying group of staff for staying home because there's no work in their department, and a group that are actively working since there's work for them to do? I think that's, as unfair as that sounds, that's what has to happen, right?
Yep,
In order to get the deduction for the forgiveness for the PPP loan.
Yeah, I think if you go back and look at some of the politicians as we were navigating wave one of CARES Act, they were pointing out some of the incentives that were in this law were going to create some unusual behaviors. And this is, an example of that where, yeah, I mean, you're going to have some people that are paid to stay home. You're going to have some people that are paid to work. But that's
right. But you think about it, right? That's their intent, right? Because they want you, that group, even though it's in the same company that's on the payroll, to be on the payroll, so they're not on the unemployment rolls.
Correct.
So yeah, it's unfortunately a byproduct of what they've done. Okay, so let's get back to the Ppp Documentation Checklist. So these are the types of reports, and every bank, I will tell you, every bank wants a different set of information. It is mind-blowing, because all the clients that we try to help, you think that, oh, well, I'll just pull the same package together for this bank, for this other client. And no, because that other client will want 3 or 4 different things. So generally what they're probably going to ask for are your 940s and your 941s or 944 payroll tax reports, because they're going to try to reconcile that to the calculation you do. And then they want your 12 months of payroll reports. Usually what we've been doing is they'll accept the calendar year, so we'll give them the payroll report at the end of the year and use that as kind of documentation for the calculation that we would do. And then your payroll report needs to show all that information, your gross wages, paid time off for each employee, vacation pay for each employee, family medical leave pay for each employee, and then the state and local unemployment insurance you would have paid on them. A lot of times, and I've seen this kind of go away, they were asking at the beginning for 1099s. The 1099s only get used in the determination as to whether you have 500 employees.
Right.
I've seen that kind of go by the wayside. I haven't seen too many recently where the banks have asked for that. And then documentation showing your health insurance costs that the company pays. And this kind of goes back to the S corporation scenario. The owners are included, their W-2 information is included in the information in this calculation. And then any documentation for the company piece of the retirement plans, 401k, simple, any kind of pension that's included. And it's kind of all over the place with bank to bank. Like I've got some banks, then they'll ask for, in the law, it doesn't say you have to give your profit and loss statement, but they're asking for a profit and loss statement for 2019. They're asking for a year-to-date profit and loss statement for 2020. So it does vary by bank. It does vary by bank. All right, so kind of the pros and cons to this program. The pros is that industries with large employment bases are going to be the biggest beneficiaries of the program. Of course, what everyone is striving for is the forgiveness of the entire debt, as long as you're planning it out and making sure that you're kind of spending it in the right way. In this whole, as messed up as this application process has been for many of my clients with the banks, there is no credit checks that they have to run or anything like that. It's not a traditional bank process. And I think that's part of why the banks are struggling, because they're like, shouldn't we check this guy's credit? And it's not part of the process. And I think they've got it figured out now. So. All right, the cons, as we talked about, is the uses are limited to payroll costs, rent, utilities, interest on debt. As we've talked about also, the problem is that your work staff, right? You've got to be able to meet the required levels of employment at the specific measurement date, so you don't get your loan forgiveness reduced. And then one of the other byproducts of this is that taking on this loan will disqualify you from getting any kind of employee retention payroll credits, which is kind of paid on to try to keep people employed also. The one thing I will bring up here is that it's come out in the last week, is that part of the CARES Act would allow you to, and I don't remember if we have it in the presentation or not, but part of this program, this CARES Act was going to allow employers to delay paying the employer portion of their FICA taxes, right? So for this year, you did not have to pay the employer portion of the FICA taxes until, I think you pay half of it at the end of 2021 and half of it at the end of 2022. They've come out with some clarification that you can do that now, even if you're getting a PPP loan. The only time you have to stop deferring your FICA taxes is when you get forgiven. So for that period of time up to your forgiveness date, you can do both, have a PPP loan and delay paying your FICA taxes.
Yep. We did get a question in the chat window, and it goes back to something that you were talking about earlier. And this particular one was a nonprofit that meets the 75% payroll amount in FTEs, but doesn't have enough expenses to get to the other 25%. Is all that forgiven, or only the portion that they spend is? And does 23% or 25% need to be spent in that 8 weeks? Bottom line is you're supposed to spend the money on allowable costs. If there's not an allowable cost
during that 8
during
weeks.
that 8 week period, if there's not an allowable cost during that 8 week period, you're not supposed to be spending the money on it. The money stays in the account. Wherever you put it, we're recommending putting it in a separate account and drawing it out as you need it. But at the end, there's no prepayment penalty. So if there's unused money, you just return it. And that's I think theoretically what they want you doing.
Well, theoretically, but they haven't even said that, right?
I know.
So I've got a client that's going to use all they have is payroll, and they're going to be left with a pot of money at the end. And right now, we don't know whether we're going to have to pay that back or if we're going to be able to use it.
Use it for anything.
Yeah, use it for payroll after the 8 weeks, basically.
Yep. So hopefully they'll get some more guidance on that.
Yeah.
Another question came up: what happens if you lay off employees right after the 8 week period? So
I don't think anything.
Yeah, I mean, you don't have any money.
If you hit the measurement date for it, then kind of all bets are off. And I think that's also one of the problems with this programs. Okay, so this one, Jack, I hope you know the answer to this one, because this was one that was sent in earlier, that I'm not an unemployment expert by any means. If the employees have been laid off and have not received unemployment yet, and we hire them, I assume the employees can still collect unemployment for the time period they were laid off.
That's my understanding, is that, but they don't want any overlap. So in other words, they can't be collecting unemployment and collecting a payment under the Paycheck Protection Program.
Yep. And then the last question before we get back to the presentation is, will the leftover money be taken out automatically? Don't know the answer to that. Don't know what the banks are going to do. I would expect that if you turn in a package for loan forgiveness, there'll be something in that process that if we're required to give the money back, that we will. So only time will tell on that, I think.
Yep. So I'm going to talk a little bit about the Economic Injury Disaster Loan Program. This is a traditional Small Business Administration program that they've had in the past. Loans are limited to a max of 2 million. And the whole thought behind this is you demonstrate that your business is being as adversely affected by the COVID-19 pandemic, and you qualify for these loans. It can be, and it's wide open, working capital, current debt obligations. So the usable nature of the funds is much broader than what you have under Paycheck Protection. If you're requesting more than 25,000, you're going to have to get collateral, provide collateral. One of the nice things about this grant or this program is you're eligible to apply for a $10,000 grant. You get it within 3 days. Even if they turn down your loan application for your economic injury, you still get to keep that $10,000 and you don't have to pay it back. It is purely a grant.
So Jack, let me just add one thing. Sure. That $10,000 grant is not coming in 3 days. Don't get your hopes up.
That's right.
I had somebody just get it this week and they had applied weeks ago. I want to say 2 or 3 weeks ago.
Wow.
But at least it finally did show up.
Yeah, well, legislation says one thing, reality says another.
Yeah, well, they're overwhelmed. They're not used to doing this volume.
That's right. Yeah, I mean, what we've heard is that, they're used to doing $20–30 billion worth of this stuff a year, and they're 10 times that between all these different programs. So it's been kind of overwhelming. If you do have loans over $200,000, they're going to be required to get a personal guarantee. And these ones, unlike the Paycheck Protection, are going through SBA. These are not going through your local banks. You're going to apply directly to SBA for these. Interest rates, 3 3/4, 2 3/4 for nonprofits. You can get term up to 30 years, defer payments for 12 months, no prepayment penalties, but unlike Paycheck Protection, none of the funds in here are forgivable. So they're purely trying to make you whole for the economic injury that you are incurring as a result of what's going on, and you're going to have to repay those funds at what appears to be a pretty favorable interest rate right now. The list of documentation that you're going to need to provide on this is pretty healthy, or have available.
It feels like a loan, right? Like a normal bank loan.
This
basically
feels like a normal loan where, identification number, articles of incorporation, information on the owners, tax forms, so that the SBA can get access to the tax information, personal financial statements from the owners, credit reports on both the entity and the owner with explanations of any negative reports, 3 years worth of tax information for the entity and for the owners, most recent financial statements for the business, year-end profit and loss statement for last year if the tax returns haven't been filed or the audit hadn't been completed, and then a current year-to-date profit and loss statement as well. And again, my understanding of what the mechanics of all this is SBA is theoretically getting this information, looking at what history is, looking at where you are today, comparing the two, and calculating, okay, here's the economic injury, the decline that we're seeing you have experienced relative to prior years, and that's the amount of the loan they're going to finance. Also goes to saying, to show that the economic injury, they want to see a current aging both in accounts payable and accounts receivable, so they can see that receivables have slowed down, payables have slowed down because cash isn't coming in as quick. Also looking at 36 months worth of sales data, so they can see if sales are declining. So it's a pretty healthy list. And then we get over into the debt schedules. The most interesting thing that I see here now at the bottom of this one is the 2 years worth of monthly cash flow projections. So they're asking you guys to be predictors of the future and how quickly everything is going to bounce back in your business. Projections are always interesting creatures. I would document the heck out of any assumptions that you're making in there. Quote authoritative sources, whether you're quoting Federal Reserve Bank things, maybe your local bank is making some economic indicators about what they think the economy is going to do, bouncing back in your particular industry, or industry groups are quoting things. Try to cite anything in the projection model that you're getting, cite it authoritatively rather than just your impression on things, and it will, I think the projection will stand to better scrutiny. Pros and cons on these. You've got the 10,000 emergency grant that gets paid out at some point. You can refinance it over into a Paycheck Protection loan at the discretion of the SBA. It can get you larger amounts of funds with lower average payrolls. You know, the Paycheck Protection is really geared towards a labor-intensive business. I could make the argument that the EIDL program is geared more towards a capital-intensive business, and you get the opportunities for that. Issues are the guarantees and the collateral. You know, be careful of the cross-collateralization requirements with your existing debt obligations. Make sure that you're checking on that. The application process is definitely more onerous, and there's not a lot of transparency into exactly how much the SBA is going to provide on these things. And Harold, I know you've had some experience with some of your clients that have pulled together all this wonderful information, and they've just sort of said, we're going to give you X dollars per employee or something like that.
Yeah, we've heard rumors of that with some clients in some of our other offices where, you know, it was kind of like almost they ignored the information we gave them relating to what the proof of loss was and just gave them X amount of dollars per employee. But, you know, I think it's you know, they're in a tough spot. They're trying to take care of a lot of people. I think these disaster loans were created to help people with hurricanes and tornadoes. No one ever envisioned that it was going to be used for this.
For a public health and pandemic, yeah.
I think it's really hard for them. You know, there's lots of people working really hard over at the SBA to make all this stuff work, and you know, eventually they're going to get it all straightened out.
I think we might have one or two more questions in the queue.
Yeah, so we got a couple questions here. So this is talking about, I think, the PPP loan. Do our employees continue to receive the additional $600 per week funded by the CARES Act when we put them back on payroll? The answer is no, because that's an unemployment $600 extra. And then it says, if not, we will likely have to pay them more to come off of unemployment. Are we allowed to pay them more? And if we hire 9 out of 12 full-time equivalents as of June 30, but the dollars are equal, can we still receive forgiveness? I think that the dollars being equal, you know, is not necessary. I mean, that's not the measurement. The measurement is people that you have. So I think if you have 9 and you had 12, you're going to get a reduction of your forgiveness amount in that case. Another question is, if you've applied for the disaster loan previously, do you have to resubmit an application for this second round of funding, or is the application still active? I believe the application is still active.
But check with your banker.
But check with the SBA basically to make sure it still is active.
Yep.
You know, it never can hurt to double check things. And then it says collateral is not required for nonprofits under certain revenue amount. Is that correct?
I am not 100% sure on that. I will.
I've not seen that. We'll have to check that and see if we can get back to you on that.
Yep.
So one of the things, quick before we kind of go on to these helpful links, I want to just make sure we've talked about this enough, because to me this is like the most important subject of the day. If you've gotten a PPP loan, it's what you do. Well, yeah, what you do with the money, right? So we've been telling all our clients, when you get those proceeds, don't put them in your checking account, because there's lots of checks that clear through your checking account. Treat it like an escrow on a real estate property. Put it in a separate bank account, and every expenditure that's qualified for loan forgiveness, transfer that money from your separate bank account to your checking account to pay those costs. And then any document you have backing up that cost should go in a file, because we're going to take that file and create a loan forgiveness package that we give to the bank. It's super important that you do that. Super important that you can show beyond a shadow of a doubt that this money was spent on allowable expenditures and not on other costs. Very, very important.
Yep, and I would go so far, if we've got, the finance folks on this call versus the owners on this call, put the money in a separate bank account, create a list of, hey, here are the expenses I'm going to pay out of this, move that money over, provide that list, wave that list under the owner's nose on a regular basis so that they see, hey, this is exactly what we're doing to pay out of the proceeds for the Paycheck Protection Program. It's going to make it easier to demonstrate that the amounts are forgivable, because the banks are going to, I think, set up a pretty decent program for figuring out what is forgivable on this. The president has set up a separate inspector general program for this, for both of these programs, to look at how money is being spent to minimize waste, fraud, and abuse. So I think the banks are going to be especially for Paycheck Protection, the banks are going to be at the front line to gather up that sort of information. So the cleaner you make the documentation, the easier the forgiveness piece is going to be, and the easier any subsequent review of the forgiveness is going to be.
All right, so that's kind of our, I think our last slide, other than our contact information, right?
Yeah.
If you have any, we got any more questions, if you want to type them in, we'll be happy to answer those.
I think the most important thing, going back to, just a couple of the highlights we want to hit, I think, as Harold said, separate bank account is going to be critical for Paycheck Protection, especially setting up that audit trail. Keeping an eye, once the loan is funded, on exactly what expenses you're paying so that you maximize the forgiveness. I think that as he said, we're starting to see clients transition out of, now that they've got these loans over, into how do I maximize forgiveness. And we're going to keep an eye out for any of the new legislation and regulations. And once we get, I guess, some more definitive guidance around how the forgiveness process is going to work mechanically, in terms of the calculation and then the submission requirements by the banks, I would envision we'd have a similar webinar to this, where we can help walk you through some helpful tips, tricks, and traps around making sure that the amounts get forgiven to the greatest extent possible.
Yeah, and we send out updates as often as we can when we get new information. So if you don't get our UHY update emails, make sure you either email Jack or I, or Jennifer. We can get you in contact with Jennifer in our office, and we'll make sure you're on the list so you get those updates when we send them out. Looks like we got one more question here, Jack. We are not allowed to increase or decrease current employees by more than 25%, correct? So what that 25% is about is they, I believe they want you to, they don't want you reducing people's compensation by more than 25% during that, on those measurement dates. So you just got to be careful of that. They don't want people taking pay cuts in order to keep the number of people on board, but it's really not paying them at the same level.
Right.
So.
All right. Well, we appreciate everybody's joining us. We look forward to continuing to work with you as we all collectively work through the ins and outs of the program, and we wish you continued success.
Yep. Thank you, and have a great afternoon.
Wash your hands.